Good morning and welcome to today's webinar from East Capital Group. My name is Marcus Rågmark and I work as part of the sales team here at East Capital Group in Stockholm. Today's webinar will focus on our East Capital Global Emerging Markets Sustainable Fund and our recently published impact report. And to discuss this, I'm very happy to have with me, founding partner and Chief Sustainability Officer at East Capital Group, Karine Hirn, live from Beijing, as well.
Hello, Marcus.
Hi, Karine, and also
Hi.
Nicholls, Portfolio Manager of our Emerging Markets Sustainable Fund, who just recently returned from a very exciting trip to India. Hi, David.
Hi, everyone.
Great. So before we kick off, I would just like to emphasize again that this Global Emerging Markets Sustainable Fund is a so-called Article 9 fund with best-in-class ESG and sustainability integration. So over the next 15-20 minutes, we'll cover several topics, including, of course, the recently published impact report. Also, how we believe that sustainability integration can support alpha generation rather than sacrifice returns for investors, what sets us apart in our ESG and sustainability work. And last but not least, we will aim to illustrate this with a couple of exciting case studies. And please do ask any questions that you may have. You'll see a live Q&A function in the top right-hand corner of your screen. Great. So without further ado, we will kick off with you, David, with the first question, which is, so can you just explain to our viewers why we do this impact report and why we think it's beneficial for investors to actually read such a report?
Sure, yeah. So good morning again, everyone. So if you look at the SFDR, I think one of the main intentions is not just that asset managers like ourselves, we use sustainability and have explicit investment objectives in the case of Article 9, but actually we really report on what the outcomes of that sort of sustainable investing approach has been. And of course, we do the formal reporting on an annual basis, but frankly, the report's quite dry. And actually, we really wanted to do a slightly more frequent and also much easier to read report so our investors can really see the results of what our sort of sustainable investment process have been. And if I briefly take you through the report, sort of highlight a few things to look at, how we start, and I could say this is obviously available on our website, so I don't suggest to read all the numbers now, but yeah, we start with these PAIs, the Principal Adverse Impact Indicators, which really take you, which is a fantastically sort of apples to apples comparison that I think can be used to compare fund to fund, but also obviously we use to compare company to company, because these are what the EU thinks are sort of the most material sustainability metrics. I think one interesting thing investors always ask about, of course, is the carbon footprints. We're 72% below the benchmark, which of course sounds fantastic. But I would say that that's predominantly a sector related to sector. So we don't invest in fossil fuels. We don't invest in brown utilities companies. We don't invest in most mining companies due to this do no significant harm issue. And so I think it would be very concerning if we did have a carbon footprint that was close or at the level of the benchmark. I think for me, what's probably more interesting here, what I always look at when I see sustainability data for funds is what the coverage actually is. So what the data coverage is. And I think the nice news here is that for scope 1 and 2, 68% of our fund report scope 1 and 2 emissions, which I think is quite impressive. You know, if you look at the same data for 2020, it was only 35% of our companies. And this is really driven by improved reporting across the regions rather than us moving to sort of companies with better reporting somehow. And I think that's great because it to some extent sort of dispels this idea that sustainable data or sustainable investment in EM isn't possible because there's no data. And it's really improving rapidly, which is nice to see. But I think that the meat of the report is very much on page 2, where we talk about SDG impact. Of course, as Marcus said, we're an Article 9 fund. We really have an explicit investment objective to invest in companies which have a positive SDG impact, typically across their value chain. And this shows the results of that work. It's all done using our proprietary tools that we'll talk a bit more about. We show the sort of which SDGs we think we're impacting. We have a few case studies there. We then talk to some sort of key stewardship data here. and then finish with what I think is quite a nice case study. This is me in late last year in visiting a microfinance company we invested into. This is about 2 hours outside of Mexico City. This is a lady who works in a shop, but is also a baker, and she was on her 16th loan from this company, and very, very positive about the impact it had on her life, but also the sort of pricing and the quality of the service they offer.
Thank you, David, for illustrating that, and I encourage everyone to read the report as well. Lots of exciting data in there, and a case study as well, as David mentioned. So if we then welcome Karine into the picture, a common misconception with sort of sustainable investment funds is that they are restricted to simply investing in renewable energy companies or other very sort of obvious sustainability plays. Our view, though, is that you know, the investment scope is very much broader, and we have the ability to invest in companies which might, you know, people might not instantly relate to as sustainable. So Karine, can you just sort of share how we define sustainable investments and what the threshold is for companies to fit into the emerging markets portfolio?
Yes, of course, with pleasure. So it is, I think, important to remind everyone that since it's an Article 9 fund, basically 100% of the portfolio, in our case, we say 90% for some obvious reason related, for instance, the fact that if we have cash in the fund, it could not be seen as a sustainable investment. But 90%, or you could say the entirety of the portfolio, needs to be classified as sustainable. Then, following the introduction of the SFDR a couple of years ago, we did a huge amount of work to define what we mean by sustainable investment and came to some a very robust framework, which consists of a number of things. The first thing is we call it the 3 steps test, which is basically, I'm not going to go too much into details because we don't have enough time, but the first part is related to what we call contribution to environmental and social factors. So this we assess through our scorecard, where we need to have at least 60% score on the environmental and social parts. The second part is related to another very important concept within the SFDR, which is called do not significant harm. And this we check, making sure that we don't have, for instance, any red flags related to environmental and social factors. And we also completely compliant in terms of both the sector exclusion, which David just mentioned now, for instance, not investing in fossil fuel, but also compliant to norm-based screening, which has to do with controversies and companies that could be accused of violating international norms and conventions. And the third part is the good governance practices, where we spend a lot of time focusing on the actual topic of, the quality of the companies we invest in as for corporate governance. And this is something that we've done from the very beginning of its capital, more than 25 years ago. And also now that since since 2016, developed our scorecard with a big weight in terms of assessing the corporate governance quality of the companies we invest in. And here we use that. On top of this, we introduced a few years ago a proprietary tool that we call the SDG Value Chain Assessment, SDG VCA, which we've mentioned to many of our clients, and I think in a couple of these webinars. Also very key for us to understand in what way companies contribute to sustainability, but not only as solution providers, but also in terms of their value chain, using a number of metrics which have to do with, which are actually not coming from us, but it's coming from international organization very well recognized in the field of sustainability, which is the SASB. And then we assess through different parameters in terms of, we call it, criticality, materiality, intentionality, additionality. And we basically would not put in the GEMS portfolio any company which does not score at least 25 in our metrics up to 100 on this SDG VCA score.
Thanks, Karine. And I can just add there that this tool, the SDG VCA tool, has also been recognized by external providers such as the UNPRI as well for how we use this in emerging markets, which is great to see. But Karine, can you please use an example just to make it even clearer to our viewers sort of how this tool works in practice, perhaps?
Yes, I mean, I think it's a great idea to do that, because we don't want our clients and investors to think this is only a theoretical. It's actually very, very concrete. So I could talk about a company that probably many people have heard about, and it's Alibaba. And Alibaba is, of course, it's a multinational company from China, from Hangzhou. They are like leading in a number of fields, such as, of course, e-commerce, but also like tech, internet, retail, and so forth. So why do we think they're sustainable? Of course, they meet all our requirements, which I just mentioned about this 3-step test. But then when we look at we do the SDG value chain assessment of Alibaba. Then we identify 2 main SDGs. The first one is SDG 11, which is about industry innovation. The second one is SDG 12, which is responsible consumption and production. And then we could, again, we have a short of time here, but basically I could just mention a number of things we believe that Alibaba is really contributing to these sustainable goals, such as the fact that, for instance, they have almost up to 10% of their sales in R&D spending. So it's all about innovation. They create millions and millions of jobs in their ecosystem. They lend a lot of money to small and medium enterprises in China. So that would be more on the part related to industry innovation. About the SDG 12, about responsible consumption and production. Look, they are champions in terms of actually energy saving efforts for such as cooling methods for their data centers. They are committed to introduce biodegradable packaging for all the parts related to their logistics systems and so forth. So clearly you can see across these 2 SDGs, there is a lot going on through Alibaba, and the disclosure has improved as well. We were leading a collaborative engagement together with other shareholders a couple of years ago, and they have improved tremendously in terms of disclosure on these factors. And last but not least, I would also like to say they actually are a solution provider. You were just mentioning, I'm in Beijing. I was taking today the subway through Beijing. It's always better to avoid a traffic jam, and using Alipay as a great way to get around. So clearly a solution provider as well for sustainable city.
Thanks, Karine, and I think very timely indeed that you are calling in from Beijing. Thanks for that. David, another common perception that investors have is that sustainability-focused funds can sort of hinder strong returns to their investors due to, for example, a more limited investment universe and other factors. Clearly, though, we argue that this isn't the case, but on the contrary, it can rather support alpha generation. The performance in our emerging markets fund has, of course, been exceptional since we launched it in 2019. So can you just elaborate a bit on this and how we believe that alpha generation can actually be supported by these types of tools that we've illustrated?
Yeah, sure. So I guess ex post, so sort of looking back, as you said, the easiest way to answer that is look at just our track record, right, which is very good. 5.5% annualized gross alpha since inception, first quartile across all emerging market funds, and not just Article 9, across 1, 3, 5, or since inception, which is January 2019.
Well, and I'll take the opportunity here to mention that I was last week in Paris, and our fund got a prize as one of the 11 best funds across all funds that are marketed in France, within the category, of course, emerging markets. But it was the prize was actually given to the fund just on the basis of its performance, consistency, and performance just levels, nothing to do with as such sustainability, impact, or contribution. So yeah, I just thought I wanted to mention that.
Yeah, thanks. And I think, yeah, we're obviously not saying that these results were achieved just because of our sustainability integration, right? It's very much more a sort of robust, dynamic investment process and on the ground approach that we've spent years developing. But detailed proprietary sustainability analysis done by the portfolio managers and analysts is a really major pillar of that work that we do to actually understand the companies we're investing into. But in terms of how sustainability integration can hinder returns, I think there's a sort of maybe 2 key areas to look at. The first one is exclusions, right? Because that's, I think, what a lot of concerns about. You know, if you're excluding a large part of your investment universe, that restricts what you can offer and maybe restricts your alpha capabilities. And actually, we looked at the numbers recently, and if you look since inception, if you look at the oil and gas mining companies and brown utility companies that we don't invest into, the alpha loss from these names that we don't hold was 31 basis points, so 0.31%. So actually, basically zero, right? If you look over over a 5-year period. So we haven't really lost out by not holding any of these names since 2019. And what's more, I think we've reduced volatility because these names are very volatile, and significantly increased the quality of the portfolio. And, and it's interesting to look at the names, like, for example, one of the large benchmarks names is Sasol, this sort of South African, I guess they do sort of chemicals companies. It's down 75% in 2019. So you miss out on some of those really low quality names. So I think we're very comfortable not holding these sectors. I'm not sure we would, even if we could. Instead, we find much more sort of quality and less volatile growth elsewhere, I would say. The second part is as we've sort of started alluding to, is this idea of this ESG analysis, and particularly the ESG scorecard. And Karine mentioned it, but we first made this in 2016, well before ESG was really a thing. But basically, we realised we're very good at doing financial modelling and company analysis like that, but weren't so very good at the sort of analysing the non-financial sides of companies. We missed some sort of quite obvious things, in fact, and probably for me the best example is I spent 2 weeks in the Cayman Islands fighting a sort of high-profile lawsuit because we totally missed that this company we're investing into was incorporated in Cayman Islands, which has very, very poor minority rights. So it really focuses on those sort of governance parts that Karine was talking about that really make a difference to stock price and can really affect shareholder value. And why does this add value? I think, well, firstly, it is done by PMs and analysts. And as a dummy, I do still cover stocks, and it's just you get such a different picture of a company compared to just doing your Excel model. Then if you fill out these sort of 50 really quite detailed questions, you understand who the owners actually are of the company, how many of their family members are on the board, how the management are incentivized. And so when you're doing that, you get a much better sort of view of how likely the management, the board are to really implement the numbers that your Excel model comes out with. So I think that's really the most important part, and that's why actually for this scorecard, 75% of the score is based on governance, because we really think that governance is the thing that drives stock price.
Good, thanks, David. And as I mentioned in the beginning, you recently returned from an exciting trip to India, and I know you also wanted to share a few words on one of our holdings in the country there. And sort of how we view that company from a also sustainability perspective.
Yes, thanks. I'd love to. And I think the last point that I haven't mentioned so far about why sustainable integration really helps. Sorry, is this idea of idea generation, right? I mean, we never have a problem to find ideas, but it's when you're looking at these sort of SDGs, and you really start to look at companies that most people probably wouldn't look for. And actually the company I will speak about in one of our sort of largest portfolio holdings in India, and a company I spent a full day in Jaipur looking around their sites a few weeks ago is Gravita, which is one of the largest recycling companies in India. They predominantly focus on lead for the moment, so lead batteries. But going forward, they're moving into lithium, paper, plastics, and bottle recycling and things like that. And it's a relatively small company. When we invested, it was around 600 million market cap. It's now closer to $1 billion because of strong performance. But it's I think it's a fascinating sector. And I think the reason recycling is so interesting, which is unappreciated, is it very, very high barriers to entry. And there's 3 reasons for that. The first thing is very difficult to source scrap. Secondly, it's very difficult to get the permits from government because there's very strict emissions requirements and things like that. Thirdly, it's very difficult to get the approvals from the OEMs, the manufacturer of these batteries, to then buy back the product. So as a result, I think this is a really fascinating company trading at something like 10 times EBITDA, so very cheap actually from an India perspective, very, very high returns on capital, and probably a company we wouldn't necessarily have looked at if we hadn't had this sort of sustainability lens as an idea generation tool.
Great, thanks, David, and a great case study and great picture as well with you visiting their site there in India recently. I see we have one question here from on the line here. And I believe it's related to the impact report you were going through, David, in the first part regarding the scope 1 and 2 emissions and other data points. What's the benchmark being used in that?
Yeah, sure. That's a great question. Should have mentioned that. We use the MSCI Emerging Markets benchmark, which is the sort of global emerging markets. We don't use any sustainability benchmarks, partly for the reason that I was saying, that we really do see ourselves as a core emerging markets fund, but also we just haven't really found a sustainable benchmark that meets our sort of is aligned with our investment process.
Thanks, David, and hope that answers the question clearly. So with that, I'd like to thank both David and Karine for joining today and for your very useful insights. I hope you've all enjoyed listening to us. Just to conclude then, I'd say that if there's 3 points we'd like you to sort of bring with you from this short webinar, it's firstly that our proprietary ESG and sustainability integration tools enable us to confidently invest in a wide variety of sectors and companies that one might not instantly sort of relate to as fully sustainable, such as renewable energy companies, for example. And sort of related to this is also the fact that an Article 9 fund therefore does not sort of hinder strong returns to investors, but on the contrary, it can really enhance returns, as we're very glad to see with our Global Emerging Markets Sustainable Fund. And as we mentioned, the performance has been really, really good. So with that, please don't hesitate to reach out to me or any one of my colleagues in case of any further questions related to the impact report itself or our fund in general, and we'll make sure to get back to you. So with that, thanks for listening in, and thank you, David and Karine.
Thank you.